Welcome everybody to our first WITI LinkSV technology talent and investment trends. We'll review kind of how we finished up last year with December. Lots happening with December, and then so many acquisitions, just like during CES, Don. I kept hearing all these announcements of, oh, did you hear this? Did you hear that? I hadn't heard much because I was heads down, but I'm excited for this. So welcome, Don, and I'm going to kick it over to you because I'm sure there's a ton to unpack.
Okay. Give me just a second here. No, exit mode. Maybe. Okay. Yes, December was. I'm having a problem with Gamma here. There we go. I enter present mode. All right. Let's get started here.
I want to kick that blue button, Don. Sorry, just
Oh,
on.
thank you. I think I'm still a Gamma novice, David.
That's all right. We get you.
Okay. So, December was a uh, perfect end to a crazy year. In December, uh, we ended up with over 25 billion in startup funding, a new high for December, and it matched literally every month of 2025. We set a new record for that month right through the year. So I'm showing 208 billion for the year. This actually could go up because we're still chasing down a few very large fundings to figure out if they happened this year or last year. But regardless, even at 208 billion, we are way above the previous high of 123 that we saw back in 2021. And in 2021, let me turn up my volume here. There we go. See if that's better. In 2021, of course, this was a zero interest rate period, and money was being invested helter-skelter by lots of different folks, lots of different entities, and it was literally a time of very low due diligence. So fast forward to 2025, we have some of those same factors, but there's no question that many of the pocketbooks that were closed from 2022 on have been opened by the VCs. Large amounts of money going different places. We're going to look at exactly where. But to emphasize my earlier comment on the spread by month, just taking it by quarter, you can see how far above previous years we were, and it's very consistent. You see, back in December of 24 is when the really big funding started to come in, and it just carried on from January of 25 all the way through the year. Now, where that money is going should be no surprise. There we go. AI. AI ruled. AI grabbed, you know, for us, about 64% of all of the startup funding. Worldwide, it was just under 50, I believe. I think PitchBook said right around 50. But final numbers aren't quite in yet for 2025. We'll see some more comprehensive analyses. We're going to be above whatever the global was, whatever the US wide was, because we have so many of the frontier model companies here in the Valley. And out of that 98 billion, about 40% went to just 8 or 9 companies. And I'm talking the OpenAI, the Anthropics, the Perplexity, huge funding rounds to a limited number of companies. Overall, we saw money going into biotech. We saw it going into fintech, which had a resurgence. 2024 was not a good year for fintech. And of course, the 8.6 billion for fintech reflects crypto, which took an upturn this year due to new administration, new regs or lack thereof. And the 14 billion, while it's just a slice of that 98 billion, that 14 billion is largely applied AI. That is the legal, the customer service, the wherever AI has been either built from the ground up, added back in. But we call it applied AI because it goes either horizontal application or vertical application.
Hello.
Keep going, Don. I think
Yep.
that was just a hot mic.
Yeah, I think so. Okay, so for startups, deal sizes continued to rise. Now, AI is driving this, but right across the board, at every stage, the average deal size, the median deal size went up. Now, in a late stage, average deal size was at $100 million, significantly above the previous year and even more above 23. Now, pre-seed didn't change much, but that's pretty much driven by YCOM because YCOM now does 4 cohorts a year. They're putting anything from 400 to 600 companies into the ecosystem. And each of those companies is getting $500,000. So the median on pre-seed is pretty much going to stay fixed at $500,000. What we are seeing happening, we have seen happening in 25, we expect this to go on in 26, is that Series A is harder and harder to get to. There was and continues to be a glut at seed. The graduation from seed to Series A takes more sales, takes traction, takes more of everything than it did 2 years ago. Okay, valuation. And this is not just AI companies, although obviously at the high end, AI companies are standouts. But right across the board, valuations on, let's see, on most of the fundings are up. There's one group that's down, and that is on, they're called bridge rounds, and they're rounds that typically a company only gets because they can't get the next round up. So a seed company may get a bridge round because the funders think there's still something there. They don't want them to go under, but there hasn't been enough progress to justify an A. So we had a lot of bridge rounds in 2025. These are companies that are trying hard, but they're not making the next tranche. AI and applied AI holds its own place in the valuation discussion. The frontier model companies are driving this, but it goes down into the application companies as well. You see OpenAI and Anthropic, they're in blue because just within the last 30 days, they've each upped their valuations. OpenAI announced a month ago they were going to go for a $1 trillion IPO. They recently announced they're going to be raising at least another 10 billion, and they want a better than 500 billion valuation for that round. Anthropic just recently closed around, I think it was October, 300 billion. Now they're raising again another 10 billion. They want 350 billion as a valuation. And this just goes right down the line. The last lower right item there, Stripe, more as a comparison item. And there's certainly AI enabled, but look at the history. It took Stripe 12 years to hit the 100 billion mark. These other companies, it's all within 2 or 3 years max. Some of them within 12 months. So that takes us to the question of the AI bubble. And if you look at the definition of what a bubble is, one key part of it is that valuations are significantly above what the companies are really worth. And it's hard to argue that that's not true at this point. There is the belief, I think we all share some portion of it, that AI is going to transform, all areas of business, many areas of our personal lives, and that the companies that win with this technology are going to deliver huge returns. It is not a question of will they deliver it? It is a question of when will they deliver it? And this line started to this discussion started in earnest midsummer, but it's gotten much, much, much more intense. Bain was the first one to come out with a study looking at the AI companies, the OpenAI, and all the companies around it, building data centers, buying, committing to compute chips, everything around what is needed to fulfill the demand that's projected. And they say $2 trillion a year in revenues is what will be needed, and they project that the companies will be 800, and this is combined AI companies, the hyperscalers, if you will, that will be 800 billion short of what is needed. Also in this discussion is power. Where is the power going to come from to complete the data center build out that's needed? And some of these studies, many of these studies, emphasize that power may be the key holding item that prevents us from meeting the hyperscalers from meeting demand in a timely fashion. The question of how this is going to come out is up in the air. But the fact that it's out there and that there is concern is now filtering down, and we start to see the effects of that in some of the early stage companies that are being funded. We see it when we get to IPOs in the public market. This is going to continue and probably increase in the level of concern expressed over the next 6 months, a year, going forward. Right. We continue to have these circular deals. There have been 3 or 4 more of them cut just in the last 45 days. The argument on this is, well, this isn't really a trade for nothing. They really are trading compute on one side for equity on the other. But again, it's an area that financial people, analysts look at, express concern, that filters out into the markets. It is certainly having an impact on the AI clouds, the core weave of the market. And we're going to continue to see this be of concern, but it's not stopping. OpenAI recently, I think within the last week, announced a couple more of these. There we go. Okay. I want to move on to M&A because before we talk about the IPO market, we want to talk about the other component of where startups exit and how they exit successfully, and M&A is the other component of that. and it has been a standout year in the Valley for mergers and acquisitions. The Q1 was quiet, likely because of the concerns about tariffs, about the new administration, about anything you can be concerned about. Q2 as well, quiet. Q3, which generally is a quiet quarter, it's the summer, things just took off. Acquisitions exploded. 128 billion total in the acquisitions that went through. Q4, that 126 billion total is a little misleading because in that is a 72 billion acquisition by Netflix of Warner Brothers. So you take that out to get a more nuanced, probably more accurate of the tech impact. But still, this is holiday season, and on December 31st, we were reviewing and posting acquisitions. That has not happened since 21 and into 22. December for sure, not since 21. Okay. We wanted to take a look at what the acquisitions meant in terms of money into the valley and money out of the valley. So breaking down Q4, we had 84 companies acquired by Silicon Valley companies, and they spent 84 billion to do that. All right, we had out of area companies acquiring Silicon Valley companies for 21 billion. And we had 39 companies acquired by other Silicon Valley companies for 21 billion. So the net here is that 42 billion came into the valley, 84 billion went out of the valley. Again, to get a more accurate view of this, you'd have to take out the 72 billion, which really would mean that we in the valley came out the better for this. But one other item to keep in mind is that these big acquisitions, and let me go back up to the last, these billion-dollar acquisitions. It is rare to see a billion-dollar acquisition of a out of the valley company by a valley company where valley investors haven't invested. So our VCs invest all over the world. A large company elsewhere in the country likely has at least one of the large Silicon Valley investors as a stockholder. So anytime there's a billion-dollar acquisition, that's good news for us. It means liquidity to the investors when the acquisition closes, and it means money coming back to eventually to LPs, to founders, and that starts the cycle over again with more companies being started and more investments being made. So we like that money comes into the valley. So going forward to 26, we don't think this is going to slow down. There's a perception that there is less regulatory oversight, that the Trump administration is not going to, for antitrust reasons, crack down on large acquisitions. And we'll talk about NVIDIA having made a couple of key ones that certainly emphasizes that. The lack of capital, and again, this gets back to general slowdown in exits. But stalled companies are going to continue to have a problem finding capital to keep going. And if you can't get new capital and you're not profitable, your only other choice is to be sold. So we think that is going to continue to drive the level of M&A that we're seeing or have seen for the last 2 quarters. The only dampening factor here, this is interesting, it's in the AI sector, which typically, because of the activity there, should be a hotbed of acquisitions. But we have these reverse acquihires in which the acquiring company gets everything. The founders, the CEO, the key engineers are hired away, and the company isn't actually bought. The key technology is licensed. The company is the non-acquired company is left to pivot and do something else. I've ranted about this before. These are bad for the valley, but they just continue. And NVIDIA is the latest offender here. Not only did they do this within Fabrica 2 months ago, they then went ahead and did a reverse acquihire with Grok. And Grok was probably their most likely competition going into the new year. They were just getting to production. Their chips were better for inference, or are better for inference than is the NVIDIA silicon. That's now been taken off the market. NVIDIA will be incorporating that IP into their chips. So the company that has 92% of the um, AI silicon market will continue to dominate and do so even more.
And that is Grok with a Q.
Right, I'm
Right.
sorry, I should have said that. There's a Grok with a K. That's not the one I'm talking about.
Yeah, Grok with the Q is the chip company.
It's the chip company we're talking about here.
Yep.
And I don't know what the remaining chip company is going to do now that everything is over with NVIDIA, but we'll see what happens there in the next year. Just a quick review on the IPO market. At least it woke up. We had $2 billion plus IPOs, billion to one in Figma. And that's the first time since the end of 22. So it's going in the right direction, but we can't really call this a breakout year. More than 24, about 3 times more than 24. But it's been so quiet since the end of 22 that that's not saying a lot. Now, this is a direct fallout from the discussions over revenue for AI companies, over the data center build out, delays and costs. In addition to concern over data centers and whether there will be revenue to finance them, you can add in there concern from the analysts about the way existing companies are financing them. And I don't just mean the fundraising. I don't mean the OpenAI doing 40 billion and 10 billion and on and on. A number of the companies like Facebook, are now doing off-balance sheet SPVs to finance data center build-outs. Now, you may have heard the word SPV in fundraising, because often a number of investors will get together to be able to make a single investment entry on a cap table for a startup. This is also an SPV with multiple investors involved. And it's basically taking the cost of building out data centers, say for Facebook, could be 20 billion, and putting it into a vehicle that is completely separate from Facebook's other financials. Financial analysts don't like these. They make them worried. Off-balance SPVs were one of the key issues back in the Enron times. So this is again causing more concern, more discussion, more downward trend. You can see CoreWeave and Oracle there having really plunged over the last couple of months. And this is not going to go away. So for the IPO 2026, we don't expect to see any of the neocloud, the AI cloud companies, doing data centers, doing IPOs without having already addressed this in some way. And how that gets addressed, we're not sure. But this is a mounting issue. So just to sum up on the IPO market, we had hoped it would be more robust going into 2026. June has a question here. We'll hit that in just a moment, June. The companies are going to continue to stay private as long as there isn't a extra bonus for them to go public. And this just becomes a chicken and the egg thing, unfortunately. There is plenty of private money for these companies to stay private. There's Databricks did a Series L, which we have never seen before. As long as that persists, we're going to continue to have this queue of companies, 750 plus. Many have filed for IPO, but there's no requirement once you've filed to actually execute the IPO. We mentioned the warning signs for the AI clouds. That's going to slow things down. Now, the only good thing out of this is for secondary funds. Secondary funds being where investors, LPs, even founders can sell existing stock. And even though the company's private, they can get some liquidity. All of the late stage companies that are staying private are running secondaries for their employees. They're typically termed tender offers. So they run these, employees are able to get some liquidity, founders can get some liquidity. It is the only way for investors and LPs to get liquidity until there is more an exit, whether it's M&A or IPO. Secondaries boomed last year. We think they're going to continue to boom and grow this year. Now, what does this mean for startups? Well, we're going to talk about that because there's one other factor that plays into this. And this is fundraising by the VCs. Last year, 2025, VCs raised the smallest amount of funds, I'll say smallest number and smallest dollar amount in the last 7-8 years. Now, 66 billion may seem like a lot, but if you look back at 22 when US VCs raised over 220 billion, you get a feel for the difference. So that 66 billion reflects the fact that LPs that have not, so the LPs, the people who've put money into existing funds who have not gotten money back, they don't want to put money into a new fund. It takes longer to raise a fund. And the people who are raising funds are the established guys, the Founders Fund, the Andreessen Horowitzes, Lux Capital. These are names that they've been around for years. They're established. They have managed to get liquidity to their investors. Many of these companies have a secondary person who is dedicated. And I'll hit that talk on dry powder in just a moment. All of this gets back to the results of the IPO drought. And one of the fallouts of this is capital is really getting concentrated in a small number of large VCs. The downside to that is twofold. One is the emerging managers who typically are the ones who will fund startups. who are doing a particular vertical that the emerging manager focuses on. They tend to be friendlier to startups. They also tend to do better returns in the long run, but right now they're having a bitch of a time raising funds because they haven't necessarily been able to return money to their first fund. So the capital concentration from a startup perspective is bad. What it means is these large companies, these large VCs, yes, they'll invest in seed, but they can't afford to do small investments. So they may make a small investment in a seed round because they want to have a place at the table if this happens to be a company who's going to do a 10x, a 20x, a 100x. But in following rounds, no, they can't afford the time to follow a lot of small investments. They have to make big bets. If you've got $1 billion under in a fund, you can't afford to be making a $100,000, $250,000 in successive rounds. So, not good for startups from the size of the fund perspective, not good from startups from the perspective of emerging managers who typically have been the best targets, particularly for the very early stage companies. Let me just touch this and then we can answer some questions. All of this information comes from the research we do for Pulse of the Valley newsletter. Bob Carr, my partner, I think he's not been able to stay for the whole thing, but and I every day scour through what's been collected by our system. We look for fundings, we look for M&A, we look for startups that are just coming out. We also look at executives in VCs as well as in the startups, and we track all of that. Have been doing this for more than 20 years. We've got a database of all that activity. And weekdays, we put out a newsletter with all of the new detail that we've found. And we also do for entrepreneurs, we try to give back. And for entrepreneurs, they get what we typically would sell for $50 for just $7 a month. We want to do everything we can to help them. We have fundraising webinars once a month, and our database is a treasure trove for startups looking for early stage angels. We're also getting into helping startups with outsourced development and some HR with a couple of partners. We can tell you more about that if you're interested. And I think that's it for now. David, I'm going to stop sharing and we can answer a couple of those questions.
Thank you, Don. That was great. Any questions before we go into breakout rooms?
There were a couple of them here.
Yeah, I was asking Dawn, which are the VCs where the capital is being concentrated?
There's probably 30 companies overall that get 75% of the capital. I can get you names off the top of my head. As a matter of fact, this morning, 15 billion closed by Andreessen Horowitz.
Mm.
You know, that'll probably be a significant percentage of what gets closed this year. 1 billion by Lux Capital, 9 billion by what was that? Oh, Lightspeed. These are all names who have been around for many, many, many years.
Yeah, the big guys, the long term. Yep. So there's
Yep.
the usual suspects. Thank you.
Yep. Michael, you had a question. Oh, this was June's question. Exit happens and the investors get liquidity. Oh, goodness. That's a much longer question than we can answer here about the taxes.
Raymond had a question. Go for it, Raymond.
The brilliant work as usual, Dawn and Bob, is really is valuable. The one that really struck me was this 15% of funds all being bridge rounds. That seems to me a startling number and signals, is this a new trend that you think that there's some big shift coming?
This has been right through 2025. Bridge rounds have been way up, and again, this is a hangover from all of the money that went out in 21, 22. Um, they haven't been able to make enough
Does that mean
progress,
that
and the
they
only thing they can do is to get a bridge round or liquidate or be sold.
right? So it's possibly that they're not the reckoning hasn't come for some of the hasty decisions that were made in 2020, 2021 then.
Well, there are huge rounds raised in 2021. There
Yeah,
were companies getting seed rounds of 30, 40 million. Um,
right.
which sounds similar to now, but back then it was very unusual to see that level of money.
Thank you,
Right.
Raymond.
And
Good
I had
stuff.
the question as well about dry powder. You said you're going to deal with that as well.
Oh, yeah, dry powder hit its high, tw 23, 24. I don't remember the exact amount, but the fact that you can see as much money going out now to AI is representative of that graph going up, 222 billion brought in by VCs. It hasn't been spent. The last figure I saw was in excess of 200 billion in dry powder in venture capital still, and that was
Wow.
6 months ago.
But if they don't
Let's go
deploy
in.
it, they can't get returns. So that's why I was just wondering
Well,
what the
that's true, but you
And
see, from 21 on, they raised this huge amount of money, but then they didn't want to deploy it. Things were, interest rates went up, things were not going well, they just held back. Only now can I say, I think I saw from PitchBook that all 88% of the 80, no, 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 20, 2020 funds have just been deployed in the last year. Okay, 2021, you're still at about 70% have been deployed, 30% have not. So yeah, they can sit on these, and why they would sit on them rather than deploy, they don't see companies where they can get the return that they tell their investors they're going to get.
thank you. And let's discuss all that in breakout rooms. I put information on the tomorrow session. Then we'll have some time
Thanks,
to kind
David.
of continue the conversation and wrap up. And here we go. Thanks everybody for joining, and thank you for watching on YouTube. I'm going to stop.